Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
Good afternoon and welcome to Money Matters with Greg. I'm Greg Farrell, CEO and owner of a wealth management firm called Farrell Wealth here locally in Valparaiso, Indiana. And we manage money for multiple families, high net worth families and their businesses nationwide. We're based in Valparaiso, but we work with clients in over 24 states. Try to bring many of the things in this show and Money Matters, things that matter to you and help you throughout your days to create your wealth, grow your wealth, protect your wealth, and distribute your wealth in lifetime and after death. We're very excited to be here today, broadcasting on WVLP 103.1 FM, and then also anywhere you pod, we transfer it to podcasts. You can also find it on your YouTube channel and anywhere else as far as our socials out there. At Farrell Wealth, you can find us. You can also email me, greg@farrellwealth.com. We'd love to have you on board. And if you have any questions or any topics you would like to be able to add, feel free to email as much as possible and help us out with some ideas and maybe things you might want to be able to talk about. Today, we're going to talk about year-end planning. Important to talk about these things ahead of time, going into December 31st, and not leaving things to chance and to happenstance. We're going to talk about the stock market, a little bit about where we are right now initially, and then also make sure you just have some steps for year-end. But first, because it is the day after Veterans Day, and I want to make sure we recognize the fact that Veterans Day was yesterday. We're very proud of our veterans. We want to thank our veterans for everything that they've done and given the ultimate sacrifice and served throughout the years. Thank you all. Also very thankful here going into Thanksgiving. Thankful for our clients. Thankful for our 2025. Thankful for the S&P 500 being up higher than we certainly envisioned. Did not see this coming. We're up. We were suggesting about 7 to 8% in the S&P, and it's up double that now. And I think everybody on the street, including us, was wrong. And we're okay with admitting that we're wrong, especially to the upside, for sure. We did not see or foresee such a exuberant year after 2 years of wonderful returns just in the past. So hope you are fully invested. Hope you are still following along with some of the things we've been talking about as far as being excited about the market. We're not really seeing anything as far as blemishes. Earnings have been coming in. Third quarter earnings have been coming in a very solid numbers. Stocks were mixed Tuesday. This week, Monday's big gains were digested. There was a big, huge rally on Monday. There was some AI news that actually happened and a soft labor market data that came out, but solid earnings guidance from many different firms, actually the global the S&P 500 was only up a modest 0.21 on Tuesday, but it was up more than almost 2% on Monday. Most equity benchmarks gapped lower at the open here this week, with tech shares leading the way as news broke that SoftBank had closed out its entire stake in NVIDIA to quote-unquote explore other AI investments. Like to know what those are, while emerging really just AI-focused cloud computing company CRW cut guidance due to supply chain bottlenecks. Now, the broader market continued to fall in early trading this week, thanks to a downbeat weekly ADP release that revealed a likely decline in the U.S. labor market in October. However, the S&P 500 began to kind of stabilize, and the index approached a psychological and very derivative sensitive 6,800 level by mid-morning after the Mag 7 member of Google that announced that it had a $6.4 billion investment to build a cloud data center in Germany. So that was very positive, which that would create 9,000 jobs annually through 2029. So that was really good news. The market really kind of continued to stabilize. The S&P ultimately turned higher late morning as investors kind of cheered the strong guidance from logistics behemoth FTX. Specifically through the holiday season, which really sort of eased concerns about the health of the U.S. consumer. The S&P 500 kind of lost a little momentum in the afternoon, so it was just a volatile day. Ultimately, it was penned about 68.50, which is what we're seeing as pretty much fair value overall as far as the market goes. I just wanted to just a quick update of where we are. We're at 68.50 on the S&P. And so far, so good as far as the years go. We've been very cautious watching earnings. Earnings are all about everything to us. And in the dot-com boom, dot-com bust that I traded through as a market maker at the Chicago Board of Options Exchange, we had prices, we had no earnings. So prices were high, earnings were terrible or negative. Now we have prices and we have earnings. So things look a little bit more expensive than they certainly appear, but we continue to see positivity and positive numbers to be able to make sure that you should stay invested and ultimately follow your plan that you have. Rest assured, right now, going into 2026, we're fully invested. We only have about 2% cash for most clients across the board. We are anxiously looking at different asset classes and researching those asset classes we'd like to be able to get a piece of that we think are a trend. That is your job as an investor and our job as investment advisors as to make sure that we have a trend, follow the trend, ride the trend, and make money off a trend as much as possible. Again, the show just is Money Matters with Greg. I'm Greg Farrell, CEO and owner of Farrell Wealth. This is our 171st episode. You can find us on Spotify, Apple, and anywhere you pod, but also on 103.1 FM WVLP here locally, broadcast at 1 o'clock on Thursdays and Saturdays replayed again at 1 o'clock. Very excited always to be a part of the WVLP family. So in talking with many advisors and ultimately clients throughout the year, we all know that it's very, very important to make sure that we're talking about taxes and year-end planning. And there is no getting around the fact that we must pay taxes throughout our lives, and implementing strategies to really help control those and to manage taxes is really a critical component to any financial plan across the board. And by taking advantage of those opportunities to reduce your taxable income and potentially maximize tax deductions, you can really redirect money to other financial goals. And that's what I want to talk about today here in the week of November 10th. Getting ready for the end of the year is really, really important. And basically come up with a game plan as to sort of minimize the taxes if possible if you have options to do that. So in addition to leveraging tax efficient investing strategies, you can really potentially reduce the taxes you pay in retirement. And as we approach the end of the year, consider this a list of tax planning strategies, even though we're not accountants and don't play one on TV. We didn't sleep at a Holiday Inn Express last night. So never going to talk about taxes in that realm as a CPA, but we do have to consider tax planning strategies as investors every single day of the year and throughout retirement for sure. While not all of these conversations may be appropriate for your situation right now, it's worth discussing that with your financial advisor, how they might fit within your financial plan. We always talk in our world about giving people options and making sure some of those options are going to stick. Some of those options are going to be great. Some of those options work, but some options don't. So at least we're educating and helping clients, adding value and making sure that some might work and they might actually be very, very beneficial to a financial plan, not only now, but in the years ahead. So some of the retirement savings strategies that I'm going to suggest here, and you just follow up as far as the end of the year, is one, very, very simply, make enough retirement plan contributions to at least capture the maximum employer match that you might be receiving in the 401k. This will reduce your taxable income and then ultimately capture free money. So if you're married and one of you is currently working, the working spouse can still make spousal IRA contributions by April 15th of the following year, subject to certain rules, of course. But I always like to be able to mention that as well. You want to consider contributions to Roth savings vehicles, potentially tax-free withdrawals down the line. As we know, Roth is tax-free withdrawals if you qualify for that. And don't ignore long-term benefits of a non-qualified investment portfolio funded with after-tax savings. Only your long-term capital gains and qualified dividends are taxed in those situations. So that is a lower rate depending on your overall. It's lower rate than ordinary income across the board for everybody, and it's a lower tax rate on IRA withdrawals as well. So in the lower income years, one of the things we always like to mention is to consider converting traditional pre-tax retirement accounts to Roth accounts. This helps in a year that you've made a little bit less income and the math really works. Obviously, you're going to sit with a professional and talk about what that might be. You don't have to convert all of your IRA. You can convert part of it. And certainly that might really help in retirement and start thinking about maybe converting by the end of the year. Most applications for converting by the end of the year have to be in by December 5th. So that's really important that you're talking and getting that done here in the month of November. And that upfront tax bill that you're going to get, because you ultimately have to come up with the taxes that you convert, it might help by that potential future growth during the tax-deferred compounding. So although that money is going to be converted and then it's going to grow tax-free throughout the rest of your life. So also, in addition, Roth accounts have no RMD requirements. We talk a lot of RMDs at the end of the year to make sure that everyone's clean and done and they have all their RMDs out. If you're 73 years or older, that's changed from 70 and a half, and now it's gone up to 72, and now today it's in this year's 73. It's going to 75 by the year 2030 unless things change. So that came about in the Secure Act 2.0, and it was probably one of the best, in my personal opinion, it's one of the best pieces of legislation that's come out of Washington, because it helps all Americans save money. It was a bipartisan bill that really all politicians can agree on little or nothing. And now that we have the government shut down, looks like it's going to go through the House today. As far as a vote goes, it's nice that everyone's going to be able to get back to work. They might agree on very little, but they can agree on the fact that Americans don't save enough money. And having a longer time to save money, a longer time to put money away at higher contribution limits is one of my favorite things about the bill. And I wish it would even go higher, but we'll see. Anyway, with a Roth, you have no R&D requirements. And ultimately, any withdrawals might be tax-free if invested correctly and within the right time. So really something to think about by the end of the year, especially if you've lost your job or have lesser income in 2025 for whatever reason. Certainly might be something to consider converting some of your IRA money into a Roth. Again, another one is contributing to flexible spending accounts and HSAs, FSAs, and HSAs at work. Your contributions are made with pre-tax dollars, and distributions for qualified medical expenses are not taxable. So really, really nice to be able to do that. Just make sure you remember to do it by the end of the year. Consider doing that before December 5th as well. I like to have a deadline of December 5th for all things, because then things can't get messed up as far as paperwork or whatever it might be. It's one of the things that we set up at Farrell Wealth is get everything in December 1st, December 5th. Let's talk about it. Also, next thing is you want to consider establishing 529 accounts for potential tax benefits. Although your contribution is not tax deductible, the growth in the funds that you own is not taxable when used for qualified education expenses. So again, very much like a Roth, 529 grows tax-free. And as long as you use it for educational expenses, as well as secondary school expenses, up to $10,000, you can use that money, but it grows tax-free. Something to think about as far as 529 balances over $10,000, they reduce financial aid by 5.64%. So when you're filling out your FAFSA, yes, that does matter, but it's still one of the best ways to save education due to tax advantages. Some states also offer tax credits or other tax advantages. Every state is different, so I highly recommend you look into your state and figure out what tax advantages you might have. Here in the state of Indiana, the tax credit is a 20% of contributions up to $7,500, which is a $1,500 credit. So 20% of $7,500 is $1,500, and it's really nice. It's a great credit. Your 529 beneficiary can be anyone, both family, non-family members. Overall, your grandparents can do 529 accounts, and 529 accounts owned by grandparents or others are not included on the FAFSA form as well. So that's just something to think about. And then any leftover funds you might have that can be rolled into an IRA for the beneficiary of the benefit of the beneficiary, subject to certain rules. That is also a new rule that came about during the Secure Act 2.0. So consider strategies and vehicles that really allow you to invest more tax efficiently is the next one. These are known as asset location in our world. And for example, municipal bonds are generally free from taxes at federal, state, and local levels if applicable. It's something to think about. If you're going to invest in tax-free vehicles, that's something to consider as far as municipal bonds. If you're in the high net worth side, you want to consider how that might affect your AMT, however, and if that does kick you into an alternative minimum tax threshold. Again, we're not accountants, don't play one on TV, but consult your tax team, consult your overall team, your financial advisor as well, to make sure that maybe something like this might be considered as far as an overall investment. One of the things that I want to also mention too is stock mutual funds with high turnovers. So they might be selling a lot and moving in and out a lot of things as far as investments. Those that have high turnover might be kicking off tax deferred or might be kicking off taxes as short-term gains coming here at the year end. So every mutual fund family is printing their most recent taxable rates that they're going to pay. And there's nothing more frustrating for clients to invest in a mutual fund and then lose money and then have to pay taxes on all the turnover that the mutual fund manager created. So you really want to make sure that you know that any of mutual funds will be coming with taxes. Most of the time, they're minimal, especially with tax efficient strategies as far as ETFs and indices. But you really want to make sure that you're cognizant of the fact that that could be coming. So it's always nice to ask and make sure that you have an awareness and you aren't blindsided with a big tax bill at the end of the year that you didn't even know was going to happen. So you ask your advisors, make sure that you know, is there a big tax bill coming for this small cap mutual fund large cap mutual fund? I'd like to know. And then finally, depending on your income, I always like to be able to mention considering a residency change to low or no income tax states. Obviously, you need legal guidance on this and you want to research all the taxes of these states, but please be aware that some states make up for low income tax with higher sales and property taxes. So you really want to make sure that you're doing your homework in regards to all of that. So that is my list for the year end. Here again, I'm Greg Farrell, CEO and owner and financial advisor at Farrell Wealth. It's a wealth management firm here locally. I hope you've enjoyed this show here at Money Matters with Greg. Please email me with any sort of content, any sort of questions, and any sort of topics you'd like to be able to talk about. And again, thank you to WVLP 103.1 FM for having us today. Certainly listen here at locally Thursday at 1 o'clock, and then replayed on Saturday at 1 o'clock Central Time. And then you can also find us anywhere you pod, Spotify, Apple, YouTube, you name it. So thanks again to everybody. Thanks once again, thanks to our veterans, and thank you for this Thanksgiving spirit that we're coming in here. We're very, very thankful to all of our clients and friends, and also extremely thankful for our Indiana Hoosiers pulling one out of State College. It's never easy to win at State College. We've never won there, and it was a magical game, and we're very thankful for our Hoosiers to being 10-0 going into this weekend. So I just had to get that in, a little bit of plug. So we are very thankful for that. Hope everybody's well. We'll talk next week. See ya.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.